Now, Europe's economic downturn is getting worse. There's been a slump in Germany's manufacturing sector this month, and of course Germany is the engine of Europe's economic growth. The order book of companies right across the Eurozone area are at their lowest levels in almost 4 years. That's according to an influential survey from the research firm Market. The car industry is particularly badly hit. Ford announced today it was closing a large factory in Belgium. Well, joining me now from Oxford is the economist Stephanie Hare, a senior analyst for Western Europe with Oxford Analytica. Stephanie, does this mean things are going to get a lot worse before they get better?
Yeah, I think that's probably a pretty accurate assessment. Certainly in the fourth quarter of this year, and the end 2012 results are going to look pretty bad for the euro area, which is expected to be in recession. But things could pick up in 2013.
Now, if Germany is slumping, what does that actually mean in reality for the rest of the Eurozone countries?
Well, we have to remember that Germany is sort of playing a double game. It trades obviously with the Eurozone, but it trades more, it exports more to China than it does to Greece, Ireland, Portugal, and Spain combined. So really, when we're seeing that Germany's numbers are slumping, we have to ask ourselves, what's causing that downturn? Is it the euro crisis, or is it the global slowdown? And in this case, it's a little bit of both.
Now, we also talk, I mean, I mentioned there Germany, we talk about Germany being the engine room of Europe, but France is often mentioned in that category as well. What about France? Because things are not looking good there either.
Well, things aren't looking good in France, and I'm afraid to say I think they're going to get a little bit worse in that country as well. They just passed their budget for 2013, and this was mostly about tax hikes. They didn't really touch spending so much, and the problem is that they are predicating their budget based on a growth assumption that many people think is very optimistic. Now, in layman terms, that just means they're being optimistic. They're not going to grow as much as they think they will, and they're going to have to cut that public spending. So you can expect more pain for France.
And if Germany and France are doing badly and they're the engine room, what does that mean for all the countries in southern Europe which are already in dire straits?
Well, I think they are looking forward to a pretty difficult year. It's going to be very painful, and there's certainly one country on the horizon that everybody's expecting to be requesting a bailout, and that's Spain. And I think if the numbers start to get quite bad in the rest of Europe, you could see pressure on Spain to take that bailout sooner than it perhaps would like to.
And before I go away and slip my wrist, is there anything to feel optimistic about?
I think there is. There's also the price manager index that came out for China is much more optimistic, and there's stimulus measures that are happening in China. So if we see demand pick up in China and the other parts of the emerging economies, we could easily see this boost up Germany's economy, and that will have a trickle-on effect to the rest of the Europe, so the rest of the Eurozone. So what we have to remember really is that we're not in an isolated ecosystem. This is something where they're all connected. So watch China, and that will help us to understand what's going to happen in Europe.
Let's hope so. Stephanie Hare, thank you very much.
Thank you.